I'll share some updates with the legislation that we're looking at with the big, beautiful bill, as Trump likes to call it. And we'll talk about some of the ramifications of that. I also have a little calculator that I'm going to share with everybody. It's still in testing, but it's a handy little tool. And then we'll do questions. So we get I don't know, 100 questions a week, something like that, from
Yes.
different people. And we'll just go through as many as we can before we run out of time. So with that, I'm just going to jump straight in. Normally I have a slideshow and everything, but there's not enough time. So let's go and let me do a share. Screen number one. The big, beautiful, or the one big, beautiful bill. That is what we are looking at for the tax legislation. So this was the House version. So this already passed the House and then went to the Senate. And currently there's a big argument going underway in the Senate. So this is not going to be the final version, but this is what we have so far. And we can glean a few insights into what's going on by going through this. So the big effect here is that most of the Tax Cut and Jobs Act is going to be made permanent. So if you remember way back when in 2017, the Tax Cut and Jobs Act was passed in a 10-year horizon. And that was because of the budget reconciliation process. They were able to, it's not that they had to do 10 years, but that's kind of like the scoring that was used by the CBO, the Congressional Budget Office. And they had all these tax cuts and they had all these tax increases so that they could get it passed and justify to themselves what was going on. Those are all expiring 2026. We're coming up on time. And it just so happens that Trump is back in office. Worked out legislation-wise, it unusually in that scenario. So one of the things, or the first thing that this bill does is it makes those Tax Cut and Jobs Act changes to the structure of tax permanent. So instead of a 10-year window, it just says ongoing. But there are a couple things that do have time windows on them of 4 years, 6 years, but most of it's going to be locked in until there's another tax reform. So what does all that mean? It pretty much means what you've gotten used to over the last 10 years is going to keep going. In the old days, we used to have exemptions. Those are gone. Was based on the number of people in your household. We're going to keep the larger standard deduction. Inside of the itemized deductions, there's a lot less that you can deduct compared to how it used to be before Tax Cut and Jobs Act. Stuff like moving expenses is going to remain non-deductible. And going along with that kind of theme, all the basic changes will remain in place. And then there are tweaks. So one of the tweaks that is interesting is the qualified business income deduction. So QBI, qualified business income, was created in Tax Cut and Jobs Act in 2017. This was a new concept where this is flow-through income. It could be from Schedule C as an unincorporated business. It could be from an S Corp. It could be from a partnership. It could be from real estate. It could be from a farm if you're a Schedule F filer. And the income from those were potentially deductible up to 20%, meaning that if I have $100,000 of activity income from one of these qualified businesses, then I might only be paying tax on 80 of it, potentially. Caveats apply. And there's a 20% deduction possibility. And in this bill, at least in this version, they're going to raise that to 23%. So it will be interesting to see if that carries through. Other things, little tweaks. In the original Tax Cut and Jobs Act, there was a horrendous revision to R&D expenses under Section 174, and they're fixing that because what they had done is back in 22, there was like one of these time windows went into effect where if you had R&D expenses like you're a software developer, software was hit especially hard, you weren't able to deduct the amount of money that you spent on salaries and computers and whatever. You had to amortize it over 5 years. You got a credit, yes, but generally the credit plus the 10% deduction you got in the first year was less than what you would have gotten from the deduction. So you're actually spending cash but not able to deduct it, and then having a larger tax bill, this phantom income that you have. So that was a major problem that's persisted the last couple of years and is fixed in this version of the bill. So it'll be interesting to see if that remains. And so this is 389 pages. I've read through. I've skimmed the whole thing, but it's a lot, and obviously is subject to change. So I'm not going to get too bogged down in the weeds. The most interesting thing about it is the new MAGA accounts. And it doesn't stand for Make America Great Again. It stands for something else. I can't remember off the top of my head. But basically, this is for kids who are under 8 years old, who it basically works like a 529 plan with some changes. So instead of only using it for education expenses, you can use it for buying a business, the which is an interesting idea. And you have to have financing on a business in order for it to qualify for qualified distribution under these proposed rules. You can use it for buying a house, you can use it for education. So it's a supercharged 529 plan, and it's possible that the government will kick in $1,000 upon a baby's birth if this gets passed. So lots of sections, lots of stuff going on. In here is also no tax on tips, no tax on overtime, no tax on Social Security benefits is not here. So what they did instead was they gave seniors a $4,000 extra deduction, which is okay, great, but that's not what you promised. There's that. And yeah, so the laundry list goes on, but all subject to revision because now it's in the Senate. So in the Senate, there are a few things going on that people are arguing about. So one is the SALT cap. So SALT is state and local taxes. So under Tax Cut and Jobs Act, the SALT deduction was limited to $10,000. So if you live in California and you own a house and you're paying 12 grand in property taxes and you're paying another 15 grand in income taxes for California, you have $27,000 of those expenses. The amount you can deduct on your federal taxes is 10. I've seen people who are highly paid employees in New York, New Jersey, those kind of areas, paying $60,000 in state income tax, and they get to deduct 10. And so that's been an argument since the Tax Cut and Jobs Act was created, and it's still an argument now. Do they lift the cap? Do they eliminate the cap? Do they modify it? All these kind of back and forth things. So that's one major area of contention. Probably the most important one for most people. There's some other technical things. The CBO was out with a report, I think it was yesterday, saying that the tax bill as written is going to add $4 trillion to the debt over the next 10 years. Maybe that's true, maybe it's not. CBO projections have never been right about anything. But, but take everything with a grain of salt at this point. Until we actually see what actually gets passed, then we'll know what's in it, and hold your expectations until then. If and when we do get a bill that's passed, signed into law, we'll go through all the different details of what's going on. But just be aware that this kind of stuff is proceeding. Like I said, past the House, now to Senate, then it has to go back to reconcile between the two versions, and then theoretically it goes to the president. I think it was Bessent, Secretary Bessent, who said he wants a bill presented as part of the July 4th ceremony as a big to-do. That's, at this point, not too far away. It's about 6 weeks. Maybe it gets done. First they said April, then they said Memorial Day. Now they're saying July 4th, so we'll see. It is what it is when it comes to politics. All right, so that's the quick news update.